Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, October 24th, 2019. We'll keep this one limited to general stock market analysis, so we'll cover the major stock indexes. I'll start out here with the charts I'm watching post that I posted this morning before the markets open today. I usually try to do that if there's some things worth noting. So we had a couple of potential market-moving economic reports, but they didn't really do much to move the needle. Durable goods came in slightly. It came in below expectations, but we had a wide range of expectations, and it was within the range. There's a common theme here. A lot of the manufacturing, some key components of the economy continue to weaken, but what doesn't is the job market. Job market's still holding up. Jobless claims came in about where expected, maybe a little bit better here, right about expectations, and the housing market continues to hold up as well. So far you have some pillars of the economy or the economic indicators have been steadily rolling over and showing some cracks, yet others are holding up. So kind of a mixed bag there, and again, it didn't really have much an effect on the market. Nor did I expect it unless there was a big move, a big surprise on any of these. As I said lately, it's all been about these FANG stocks earnings. So yesterday we had Microsoft. Today we had, after the close, in Amazon and Intel. We'll see how those play out. Amazon looks like they missed. I'll try to get to those stocks in a second, and Intel, and that's knocking the futures down a little bit. But I always say this: don't overreact or do too much based on the initial reaction. You're going to have there's two components, or really three, if you will, of a company's earnings. There is the actual release of the earnings report, and traders will react to that, bullish or bearish, depending on what they think. Then it's followed up by the company's conference call. Not all, but most companies will do a conference call, and many give forward guidance, tell you what's going on, and that can turn things around, or it can exacerbate a gain or loss. So that's the second component that's yet to happen. And then most importantly too is see how those stocks trade in the regular session the following day. After hours is kind of like the wild west. If you trade, things can fly around. You don't have the liquidity. There's not the big, the institutions can't trade in large blocks as they often do during the regular session when there's a lot more liquidity. So again, the three components are the earnings report, the conference call and guidance, and then of course what's the lasting reaction that sticks when these guys open for trading tomorrow. How do they close the day after the market's had time to fully digest everything? So we'll take a look at that. As far as markets, let's roll into that. This morning I posted QQQ and highlighted the fact we're still it's been about 9 days now since we've been struggling with the downtrend line. Here, let me pull up the current chart here. All right, so here's the QQQ daily chart, and it's we have this downtrend line that comes off the highs back here on July 26th, and you can see we've been struggling now. 1, 2, 3, 4, 5, 6, 7, 8 candles, 8 failures under that level. It looks to me, just from the look of when I see a stock that's holding there, it looks like it wants to punch up there. I would put coin toss odds whether or not we make that scenario. Again, I have one overall outlook for the market, and that one's still bearish. Nothing has changed there because nothing has changed in the technicals. To micro call that or hone down on that call, I have a more bullish of the bearish scenarios that says there's minimal upside, which I've been saying now for months, and we're talking minimal upside over the previous all-time high right there, minimal being anywhere from 1 to 3-4%. That has been the MO of this market for the last 2 years now. It pops, breaks previous highs every few months, does so with a marginal new high anywhere from less than 1% to no more than 3% or so, and that's in the broad market, S&P 500. And then that's been followed by correction, just like we had a high here and a break. We had a high back here. This was a new high correction. And so, again, because that is the MO, the odds almost favor it. But we'll see. Wouldn't surprise me one bit because it's been such a well telegraphed, or I should say a very obvious pattern, if you will. Who knows? Maybe the market will surprise everyone. But like I said, near-term direction, flip a coin. My convictions aren't very high. We've been pushing against this level for 8 days, so depending on what happens with these stocks. And again, don't forget, guys, we have Apple next week and the rest of the FANG stocks. So once next week is out of the way, I can say this: we will be over the hump for earnings. Right now, we are this in next week. To me, is a peak earnings season. I don't know what they'll tell you on CNBC or in the press or media as far as number of companies. That doesn't matter to me. It's the magnitude, the size of the companies reporting this week and next. Because as I've said for a long time, this market's all about the tech sector. These tech companies are the largest companies in the world, the largest publicly traded companies, and more importantly, they're the largest heavy-weighted components of the S&P 500 and Nasdaq 100, and so they'll set the tone for where we go. So and again, we'll know by next week. So that's it. I'll continue to focus my trading efforts where there's other opportunities to make money, commodities, natural gas, crude, pot stocks, things that we've been looking at that have a much better risk reward profile than the broad market. But won't ever take my eye off the broad market. This thing can, if it's going to continue to grind higher for a while, I'm not going to see a lot of attractive risk reward profile for going long, nor do we have any sell signals yet to go short. So it's kind of just a watch and see kind of thing right now. But that's it. We'll watch these trend lines. Pretty much just watch the recent highs. If we're going to break them, it should be impulsive, and it probably would be if we get a break. So that's what you want to see. And so that could trigger that a rally, like I said, which I think will be limited to maybe a few percentage points, and we'll have to watch from there. We'll look for any signs of a reversal, and again, be prepared for anything in case we fail here. Like I like to say, resistance is resistance until unless broken. So we have the stock market right now at dual resistance levels. Don't forget, we have the trend line off the December 24th lows. We broke down pretty impulsively, and we've been back testing that. And we're also we've been testing, as I said, for the last 8 days, testing that downtrend line off the recent highs there. This is certainly a possibility, and we'll probably have a much better idea by the end of next week, based on all those companies reporting. So that's QQQ, SPY, same story really. SPY, you have almost instead of a downtrend line, I'm more focused on a horizontal level, about 302 and a quarter or so on SPY. You can see again that's the recent, the previous all-time high. Well, that was until this one, and again that was a slightly higher high made than over that previous high, followed by a correction. As we had a high here, we broke out to new highs, less than 3% rally, we corrected, and so the pattern continues. That's what we're looking at, and that's why I have a question mark. Will we get another divergent high? And if it's much more than that, we burn through the divergences, and then I'll have to reassess things, see how things look. But as of now, we're still broken down on the weekly charts below those December 24th trend lines, and the XLK, tech, everything else. There's XLK right there. Shows better on a weekly chart. You can see December 24th uptrend line, breakdown 1, 2, 3. That third candle last week was a red candle. Well, hit the trend. We kiss that trend line each and every week and haven't got through it. And we've started to roll down off it a little bit, but not impulsively. We need to put this level in the rearview mirror to say that was a breakdown and back test. Right now we're still back testing, and so maybe we back test to the point just like and probably would if the markets are going to make a marginal new high, so will XLK. And so, but you're seeing the same thing there. It's going to be a divergent high if that happens. So that's the bigger picture, and let's drill down to the 60-minute charts and look at the shorter term picture, and this might give us some clues for what happens tomorrow and then next week. All right, so my focus in the last few weeks has been the price channel on QQQ, and that's offered some nice short-term or active trading ops. It recently broke down. I'm referring to this price channel here. The midpoint line is in yellow right there, and so you have these clusters of trades or candles above or below. And the last time we broke down below, it was impulsive. I guess a lot of people start to pick up on that you have that midpoint line, and boom, it worked. We shot down Came in, tested the top of the gap there at 190.74, big old gap right down below, which has yet to been filled, by the way. So that's food for thought there. And as I said, when we broke down, I didn't expect us to go much farther, especially below that, because of the big earnings reports. And so that's what's happened. We've come up, and from a simple technical perspective, we broke down and we back tested that channel right there as well. So that's what the 60-minute chart looks like. Let's take a look at the futures. All right, something I pointed out for quite a while now. This is a 60-minute chart of NQ, NASDAQ 100 futures. I know there are a lot of lines here, but the most important lines on this chart are the ones right here. We put in a divergent high, first divergent high in a while, especially of this scope, of this magnitude. We had negative divergence from this point right here. It was a little bit there on the PPO, but I'm drawing right here off this peak on the RSI and this peak on the PPO. So it was a divergent high. And we went on, we broke this little minor trend line here, and we moved down. And so we've been kind of stair-stepping slightly lower. I don't want to call this a downtrend yet. Technically it is, but it's really too early. I'm not going to put a lot of stock in it. And but as I said this morning in the earlier video today for subscribers, you do have at this point a series of each one of these slightly lower high, and you have a series of 3 lower lows so far. So where do we go from here? If we pop up much above there, we're probably going to break out, as I said, if we go much higher above today's highs. You have a big level here on NQ, about 79.80, and you can see as these circles I show here, 1, 2, 3, 4, 5 circles. Last time we were there, I posted right here the other day. I gave you, what was it? I called it 9 reasons, including these overbought reasons and all those tags at that level that I expected to pull back. There it was. We got that pull back there, and you can see we've now stair-stepped up. We moved up, and we have this trend line. In fact, that was posted this morning, and we came in and tested it right there. So there was a successful test of this trend line, and you can see this chart is in real time. We closed right here today, but with Amazon, it's knocked us back down to that trend line. So very near term, a break of this trend line should trigger the next sell signal. Look for an impulsive break and or solid 60-minute close, and that could take us down. So this market can go either way. Let's see what Amazon and Intel have to say tonight, and how the market reacts. Now, if we do break down, then I'll be watching this low. If we take out that previous low right there, now you do have the makings again of an early downtrend with a series of lower highs and lower lows. And again, the divergence here, you can even see we almost had divergence there. It's about flatline divergence from this point to this point, and you can see this divergent line, or divergence line I should say. So really, if we pop up, it's the same story no matter what, all the way down to the 60-minute chart. You're going to have divergence unless we go quite a bit higher right now. So that's a near-term level to watch. Where do we go from there? Well, we have most of the fangs out. We still have Apple to go. We'll see. We'll see. It'd be interesting if the market fails to pop the new highs. It's the bulls. You know, the ball's in the bulls' courts right now. I just turned on CNBC right before this video. I never watch CNBC. I'll turn it on for 2 reasons: an FOMC announcement, or when there's earnings, or I should, and a third reason, if there's a random big move in the market out of nowhere, I'll turn it on, see what's going on there. Other than that, prefer to get my news from the written, online or online media. Wall Street Journal, Barron's, those kind of more reputable sources. But with that being said, what I was going to get at is either the 3 or 4 talking heads I heard just completely bullish. So we're seeing bullish sentiment start to spike up, with this market pushing at the new highs. So again, it would catch a lot of traders off guard if we fail to make new highs. So I'm going to watch for that. And should we go up, I already gave you what my upside would be. I don't have a number because when you break the new highs, there's not resistance. You don't have a resistance level to target. You can try to put up Fibonacci projections, things like that to try to guesstimate, but like I said, let's just say within a few percentage points is about, I think, the upside before a significant reversal there. But we'll watch the technicals. We'll see how the charts develop. And let me see what else I want to show you. ES, S&P 500, yeah, these are the same trend lines I showed you this morning for members before the market opened. The charts I'm watching, and in the video I did today, you have this divergence building. The last time you had negative divergence of this magnitude right here was back here. You can see it about comparable divergences, and we were at around the same level, pushing up, trying to break out of those previous highs right there, and you can see, boom, it led to this drop. Those divergences played out as they so often do. So if these divergences play out again, your first clue or sell signal is going to be a break of the trend line, just like that trend line I showed you on NQ. And by the way, you want to see them both break. You want to see not one but two. If NQ breaks, starts to go down, but ES holds its support and rallies, and NQ will probably prove to be a false breakdown, and vice versa. So the sell signals come on impulsive breaks, especially solid 60-minute closes below both these uptrend lines right here. And then support there is about 29.80, pretty decent support right there on ES. In fact, it goes all the way back. It's some nice support. Should that break, that would set the stage for possibly a deeper correction there. Again, because of earnings and because we have the conference calls tonight, then the market participants are going to, the big boys will step on the field at 9:30 a.m. tomorrow, plus Apple and a few more big names next week. I'm going to say this, the odds for whipsaw signals are elevated. That's just part of the game. I wish I could tell you otherwise, but break down here. That could be just a temporary, small, minor move. Like I said, minimum target right here if you're looking for a quick trade, 29.80. But if it breaks down and you think there's more, you can always set your stop at entry and let it ride. See if it opens a door to a bigger downside. And small cap stocks, as I posted this morning, RTY and IWM had broken down. I'll try to get your IWM chart in a second. You had this wedge here, negative divergence right there. And I put in alternative, what I called BOD trend line this morning. Showed you at that. We were working our way up there. BOD is a benefit of the doubt trend line. And it broke down, but what I said is I don't expect it to go too far unless the large caps break down. So there was a sell signal, but I had a big question mark by it because you would need to see the large caps follow suit. Small caps are only going to go so far without the large caps. So there it is. It did put small caps on a sell signal, but they're not. Again, that might prove to be just a little brief whipsaw signal. What you need to see right about here, I don't have the hard numbers on that level, right about that line, you can see we're kind of boxed in right here in this trading range with IW, or RTY, I should say, small cap ETF. We are below these trend lines, so if the large caps break down, I would expect this to play out. If the large caps do not break down or have a little whipsaw and go up, then I would probably expect more upside here. But here's a common theme, right? The RTY, the small caps, have put in, as I showed you here, just as with the large caps, negative divergence on the 60-minute time frame. Just like we had bullish divergence back here, that was a catalyst for the rally that's going on right now. There was your divergent low right there, and that was a rally. Now, at the same time, we have the risk-off assets. I'm not going to get into gold and all that because we might have some pending active trades. I covered gold extensively today, silver, platinum, and precious metals, but I'll hit on Treasury here. So gold had some potential bullish developments today. So did silver and some other things, and platinum recently. And the Treasury bonds are really not running yet, but as I pointed out, it's interesting to note that these are the king of risk-off assets. Treasuries number 1, gold number 2, I would say, for risk-off assets. And Treasury bonds, at the same time the equity indexes have those divergent highs, which are bearish, you have the divergent lows here on, and this is ZB, by the way, guys, sorry. ZB is the 30-year Treasury bond futures. And so, as I said earlier today, and even yesterday, ZB has resistance, a trend line here. And we were out there yesterday, we pulled back, we hit it again today. If ZB breaks out above here, what this will show you, and what this is telling me now, that you have a potential bullish setup. And I'll tell you this too. If the market pops new highs, ZB will probably take another leg down, but ZB has plenty of room, just like the stock market has plenty of room to extend the divergences. ZB can extend these bullish divergences. So this kind of meshes with my analysis for the broad market. If we pop the highs in the stock market, the recent highs, it'll probably be a marginal new high. You'll see treasuries come down, put in a marginal new low, and that will still be a divergent low and set the stage for a possible or a likely, I'd say, a likely reversal here. And again, this, smart money will flock into treasuries. And I think we're seeing what looks like some accumulation here. But again, you don't have a buy signal, just like you don't have a sell signal on the equity market. And again, that buy signal, an early buy signal would come on a break there above that trend line, and then a secondary and even more powerful buy signal on a break above 161.043 on that CB. And similar story for ZN, the 10-year Treasury bond futures. I like to watch them both. And you can see there you had dual downtrend lines. Both of those have been broken out, so you actually have ZB, the 10-year bond, on a buy signal. A little work to be done. I just showed you those levels I want to see taken out on ZB, the 30-year bond, but on the 10-year we broke out, back tested, and we're still above both this trend line and this one. This one makes up a bullish falling wedge pattern, again confirmed with positive divergence and plenty of room. If the treasuries take another jog down, plenty of room to extend those divergences. So it just ties back into my common theme that I'm not very confident in whether the next 2 to 3% in the market is up or down, but I am pretty confident that the next 10% or more in the market will be down. So that kind of aligns with this. Should all these technicals be negated and burned through, well, then I'll just have to adapt at the time. But the good thing about it is nobody puts a gun to your head and says you can only trade the stock market. There are plenty of other opportunities out there, things that have much better risk-reward profiles right now. Like our Tilray long, we hit our second target for a 12% gain in just a week, and it's came very close to the third target today. So I'll continue to focus on trading ops like that with much more attractive risk-reward profiles, but certainly won't take my eye off the broad markets. We're going to wrap it up here. Let's just see how Amazon and Intel follow through tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.